You are all smiles. You know what's funny, Karina mentioned it, is that we've had some of these kind of numbers that have caused some concern for investors, and then we seem to sell off in the morning, and then later on investors digest it and they feel like, oh, it doesn't matter. We're going to keep on buying anyways. What's going on with that?
I think the investors are saying it's not as bad as we thought it could have been. We could have had a huge rebound in areas where we didn't expect. And one area was surprising, was in transportation. The service inflation rate is now over 5.25%. So that really shows you that the Fed has a lot more work to do to bring the underlying price inflation back down again. But the markets were saying, hey, it could have been even worse because it could have been much more widespread. It could have been outside of just insurance and transportation services and medical services that you just mentioned earlier. And I think the sigh of relief came, and also they're looking forward to profits. Because what tomorrow's release and what pros are doing is to say, let's look at the CPI. That's what they're charging the retailers. But also let's look at the PPI, because that's what's costing the firms to build stuff and make stuff. And if the spread between CPI and PPI is wide, that is, PPI is restrained, but even though CPI is a little bit hot, that means profit margins will be strong. And that's the thing that's...
In other words, you're saying that even if CPI is high, the companies seem to be okay with it. What all they care about is the input costs coming in lower, because that's essentially their profit margin. So if tomorrow's number comes in hot on the PPI, then do we panic?
Then we're going to say the goods deflation or disinflation that we've been seeing may be over, and we may not be getting that kind of dampening on the good side. Don't forget, the service side is still going to be a problem because wages and workers' wage increases are still well above 4%, which is a little bit high for sustaining a 2% pace of inflation ultimately.
So, okay. So again, as the economist, what should the expectations be for just everyday people like you and I who go about our day, we go to work, we come home, we buy food? It seems like at least the inflation numbers that we were talking about, eggs and bacon before, have calmed down. And I know you mentioned like airlines and transportation, but it feels like the expectation by at least the general public is that it is under control. Is it not?
Yes. In fact, the ultimate message I give all my friends is that chill, because the markets have overreacted. They've always thought that this inflation was going to be so strong that it will get back to 2% really fast, and the Fed will start cutting rates like crazy by March. No, this number is telling us it's not going to be as smooth and as fast as you thought, but it is on the way down, and everybody at the Fed is absolutely convinced it's on the way down. The matter is when, how fast, and that means that they're going to restrain themselves from cutting rates until they're convinced we're on our way to 2% inflation.
One of the key areas that we often talk about here in the newsroom, and of course at the dinner table with our friends, is the cost of living, specifically housing, right? Whether you own a home or want to buy a home, or you currently rent. The renter's equivalent inflation did tick up, perhaps more than some expected. And I heard some other experts say that would ultimately come down, and it got me thinking that, are you saying that rents should ultimately come down in 2024? Or not?
Let's remember the difference between the cost of living, which is the level of prices, and the rate of inflation, which is the pace at which prices are rising. The pace at which prices are rising is slowing down. That's what the Fed wants. But that doesn't help you and me when we say, gee, our rents are going up, but they're going up by less, but we're still having higher rent to pay, or our wages catching up with that. That's the cost of living, and that's what you and I worry about. Our wages may not keep pace with the cost of living. Housing may actually come back when interest rates come back down, but that just means that the owner's equivalent rent, which is measured by the CPI, may start popping up again. So again, we may not find the relief that we're hoping for in housing costs, because unless you're living in the super luxury areas of Manhattan, where the surplus of apartments coming on the market is keeping a lid on rent price, I think rental rates are still continuing to rise.
Yeah, it's probably the #1 thing that I hear people complain about, right? Yes, we joke a little bit about the eggs and bacon, but the rent is the most major component of what most people spend money on. And when the Feds increased rates last year, a lot of people thought, well, that's gonna lower the price of homes, that's gonna bring rents down, we'll have more supply. And that really hasn't happened. And one could argue that if that was the expectation of what the Fed wanted to do, and here we are today, it hasn't worked. The Fed has failed at bringing down the cost of living, specifically housing.
You're absolutely right. In fact, the Fed is absolutely stymied by the fact that the channels of transmission that normally go through the housing market is not working the way it's supposed to. It's not restraining the demand for housing. In fact, the pent-up demand for housing is so strong right now, and the supply is so low that the minute interest rates come back down to, mortgage rates come back down to somewhere in the 6s or even 5s, you're going to see this burst of demand for housing that's going to drive up prices even more. So I think the housing market is a little bit weird right now because of the supply and demand imbalance. So many people wanting to buy homes, and there's so few homes ready to buy, and even fewer homes because nobody wants to sell.
And to follow up on that, if the expectation is that they're going to cut rates, if, let's just say the Feds did cut rates, whether it's March or April or May, that would only fuel the demand for these homes and apartments, which would fuel the problem that they were trying to solve in the first place. I mean, why should the Fed cut rates if this is the one of the problems they were trying to solve?
Because there are other problems, namely the inflation rate in car insurance prices, the inflation rate in the auto mechanics are charging, the doctors are charging. Those service price inflation rates are still way high. In order to restrain those, we need high interest rates to restrain demand. Housing market is going to be a problem, and it's really a conundrum how to deal with housing other than build more housing. And the answer to that, Phil, by the way, is regulation. One of the biggest restraints against more housing coming on the market is land use, right? Land regulation. And we do some reforms there, it'll help to increase the supply of housing for everybody.
Anyone who's fixed a car or done some remodeling knows that the price of fixing things, whether it's a plumber or an electrician, has really gone through the roof. William and Lee, always good to see you, my friend. Thank you.
Happy New Year.